Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about business planning for small business owners. Last week, episode 10 in this season, we talked about individuals. And look, you might need to consider both individuals and small business opportunities when doing your tax planning. So both those episodes are going to be today's and last week's are going to be relevant to you. But of course, there's a lot more moving parts when we're running a small business, not every small business, but most of them. And so it's really important to understand, what actions that you can take before the end of the financial year to make sure that you're going to be in a position to minimize tax, to give yourself plenty of flexibility on how you're going to distribute or deal with the taxable profit that you've got this year, and not regret that maybe in 12 months' time when your holistic accountant is preparing your tax returns and financial statements, whether it's 6 or 12 months down the track, and not look back and go, wow, we missed this opportunity because we didn't think proactively about it. So let's get into it, Mena. I guess it starts with, trying to work out what taxable income we've got to play with this year.
That's right. Step one is forecasting. So what we typically do is we forecast a P&L, or as much as we can in terms of a set of financial reports, because there's no real great benefit in doing any sort of tax planning without knowing where your numbers actually lie. And that's typically why we sort of wait till around April, May, even sometimes to early June to do tax planning, just because we want as much financial data as possible to project out what the financial year income will be. So it's an essential place to start when it comes to all tax planning. Then once we prepare the financial reports, what we do is we prepare a forecast tax position. So this could cover things such as certain strategies we implement, whether we're going to sort of do a certain distribution strategy, acquisition strategy, or review certain sort of assets and so forth, which we'll discuss further on in the podcast. And then we basically forecast what your future PAYG installments are going to be. If we need to do, for example, larger tax installments before 30 June, just so that we can get some franking credits to allow us to pay higher dividends or anything like that. So that's really step one.
The next step is to think about superannuation. And quite often, people that are self-employed kind of ignore superannuation. The common sort of feedback that I will get is, I can't access it till I'm 60. They're always changing the rules, and people are attracted to being self-employed because they want to have more control over their, financial situation and financial future. I get all those things, but super is still really attractive from both a tax planning perspective and then also from a ownership perspective in terms of holding investments. So I think ignoring it in totality doesn't always make sense. But what we want to do is make sure we understand how superannuation fits into the distribution strategy and the way of minimising the tax you might pay this year. So that is, are you going to make super contributions? Should you make super contributions? And therefore, in what entity? Is that going to be in your trading entity? Are we going to wait for profit to sort of flow out of a distribution from a family trust and we want that deduction in your personal name? What does that all look like? And it's part of that strategy because we need to work out, well, if we want them in the business entity, we actually have to physically make those contributions well before 30 June to make sure we're going to be able to capture that tax deduction. But in addition to super contributions, we want to know, how does superannuation fit in your overall strategy? So, will you benefit from having a self-managed super fund? And by the way, I should say, we're probably a little bit different than most accountants in that we don't recommend the establishment of a lot of self-managed super funds. So it's not just a sort of go-to strategy point for us just because you're self-employed, you need one. But there are some benefits, some really strong benefits of having one and running your own fund. Both Mena and I have our own self-managed super fund, so we're sort of putting our money where our mouth is, if you like. And how does super fit in with, your overall longer-term strategy in terms of helping you minimize capital gains tax if you ever go and sell your business, and ultimately transitioning into retirement, trying to get as much of money into super as possible. As of 1 July, each individual can have up to $2 million inside super, and it's completely tax-free, which means that you can invest that money and not pay any income tax on the investment income or the capital gains that you make. So again, it's a really great opportunity that shouldn't be overlooked, and something that we need to understand when we're doing tax planning for a client. We need to understand how superannuation kind of fits into that overall strategy.
The next thing we typically look at is trade debtors. Now, a lot of clients, they raise a lot of invoices, don't manage the debtors well, and they can end up having debtors in excess of 60, 90 days. And what ends up happening is you're paying tax on those debtors if you're not reviewing them, and if they turn into bad debts, you've basically essentially paid tax in advance when you really didn't need to. So we typically recommend our clients thoroughly vet their debtors, write off any bad debts that they need to do. And in addition, what we also ask clients to do is review the debtors to assess whether any of it should be typically what we refer to be as unearned income. Now, unearned income is actually things that you've invoiced in advance, but you haven't rendered any sort of work or services for. So we typically don't put that in trade debtors or in your P&L, because at the end of the day, you haven't realised that income. You're basically just holding those funds sort of on trust until those works are completed. So in those scenarios, what we typically do is we put them in the balance sheet as unearned income, and we only realise the income once the service is actually completed. So you're not actually paying tax on those funds before 30 June. Then what we also encourage clients to do is review any sort of related party loans within the business and the related entities and so forth. The reason we want to do that is we want to avoid any Division 7A issues or manage any Division 7A issues, because some loans between those interrelated entities can raise interest as a result of these Division 7A loans. So we want to navigate these as best as possible and make cash flow from one entity to another if we have to, just to avoid the issue.
And we should say managing your trade debtors should be something that, is really important to the business throughout the year, not just at the end of the year. And so your holistic accountant really does need to understand your business and when you have legally earned that income in terms of executing those services or delivering the goods or whatever it is, again, so they can help you manage those tax liabilities. But keeping that debtor turnover, keeping the debtors low, making sure they're fully recoverable, these aren't just end of year sort of functions. They're something that we should be working on throughout the year. And there's lots of tools and payment terms and all those sorts of things to really help businesses with keeping debtors low and fully recoverable, a lot more than there was maybe sort of 10 years ago, although, again, I'm showing my age. The next thing we want to review here, particularly if we're selling a product, is stock on hand. Now, of course, we want to do a stock take around about or close to the end of the financial year just to make sure that our records are correct and the stock that we have that's recorded that we're holding in our system is actually there and complete and accurate. And then we want to think about what is the value of the stock. So is there any obsolete stock that needs to be either written down or written off? And then what about the recoverable value of the existing stock? I mean, if there's some stock that's a little bit stale, we think it's saleable, but maybe not at full price, that's an opportunity for us to write that down. That'll increase our cost of goods sold and therefore reduce the profit and save us on a bit of tax.
Next thing you could do is review your plant and equipment. So basically your fixed asset register, and work with your holistic accountant to basically assess what assets are actually still working, functional, and actually worth something. Now, typically assets are sort of depreciated at sort of the guidelines that are depicted by the ATO, but you have a right to actually self-review these and self-assess whether there should be accelerated depreciation or whether the equipment should be written off in its entirety. So we generally recommend our clients go through this with their advisors just to make sure that, to realise any depreciation benefits before 30 June.
The next thing you want to think about is your business structure and, how you're actually going to get the money out. When I say the money, the profit, the taxable profit out of those entities, and use it in a way that's going to be most efficient for you from a personal wealth perspective, because that's the key thing. And that's something that we find, a lot of advisors, a lot of older fashioned accountants can tend to be quite focused on just minimising tax this year, but sometimes in a way that gives rise to too much retained earnings in a trading entity, which is a asset protection risk, or potentially in a way that's not going to allow the individuals behind the business to put that money to sort of good use. So you want to think about, how are the shares in the trading company owned, or how are the units in the unit trust owned, or if it's a discretionary trust, who are the beneficiaries of that trust, all those sorts of things to think about. Well, what are options do we have in terms of getting that profit out? And then also think about whether we want to put some salaries through the business. For instance, that might be useful, for example, if both yourself and your spouse are working in the business, but the shares in the trading company are owned by one of those spouses. Well, let's pay the other spouse some taxable income via a salary, because they're actually genuinely doing work for the business. And that's an opportunity for us then to kind of split that income, if you like. But if we don't do that before 30 June, we don't put it through single touch payroll and do it appropriately, we might not have that opportunity in the future. So that's another way for us just to really think about making sure our structures are correct. Also, if we think we operate ultimately in a family trust environment, whether it's via a company or directly, and we want to have the opportunity to distribute into a bucket company, corporate beneficiary, we want to make sure that bucket company exists before 30 June. So we might want to set up new structures or new entities prior to doing that.
Another consideration is around FBT, or fringe benefits tax. Now, again, this is a topic that the ATO is closely monitoring, and if it's not sort of navigated well, then you can end up with sort of interest and penalties as a result of non-compliance. So typically what we encourage our clients to do is review their what we call the staff amenities ledger, any sort of other benefits that they provide to their staff, to see if there's any sort of FBT liabilities. And if there is, how do we navigate those? Do we need to do things such as recipient contributions before 30 June? How do we report that as part of the FBT returns? You've got to navigate also the FBT legislation. Some of these benefits might fall under sort of the minor and infrequent rules, where you're sort of allowed up to sort of $300 of benefits per employee sporadically throughout the year at random. So it's really important to understand how the FBT legislation works with income tax, and what you can do to sort of strategically navigate these to sort of avoid the tax in its entirety.
The next thing to think about, which kind of contradicts a little bit what I spoke about in terms of potentially paying your spouse a salary through the business or something like that, is to really think about payroll tax as well. Quite often we tend to be really focused on income tax or capital gains tax, but payroll tax is a bit insidious in that it can really kind of creep up on us. Now, for those people that operate a business in Victoria, the threshold is $900,000 a year. So if your wage bill, including superannuation payments, is above $900,000, you'll have to pay payroll tax, which is levied at a rate of 4.85% on any amount that exceeds the $900,000 threshold. So sometimes we see situations where we've got quite a large business, and the principals in that business, the owners of that business, are being paid a salary through the business, which might have suited them, way back when they designed those arrangements, but might actually be giving rise to paying more payroll tax. Again, if they're well in excess of the $900,000 threshold, then they'll be paying extra almost 5% tax to the government. In that situation, we would look for alternatives. Is there a way in which we can structure the profit distribution so that it's business income rather than PAYG income? We need to think about PSI rules. Is there any personal services income, and will that have an impact on it as well? But it's one thing to think about, and something that's quite often overlooked in terms of trying to minimise payroll tax in a business. So look, there's some of the common tax planning opportunities that we will tackle as we lead into the end of the financial year for clients that are self-employed. Of course, these are just general in nature, and of course nothing in this podcast is specific tax or personal advice, but there could be a whole bunch of other opportunities for you depending on your business and circumstances, but we feel like that gives you a really good starting point. And if you're able to tick all those boxes, deal with all those matters that were spoken about, then you'll be miles in front. But we would encourage all listeners to engage with their holistic accountant well before the end of the financial year, so it's not a mad rush in the last few weeks of the financial year to get all these stuff done. And also to avoid having to look back and kick ourselves that we didn't set up a company or we didn't put some remuneration through the payroll before 30 June, because it's now we can't optimise our tax position at a group level. So we hope that's been really useful. Of course, if you have any questions, don't hesitate to reach out. And until next week, bye for now.